Hi, my name is Javi, and for those of you that don't know me, I am an investor that trades. People say, "Hey, wait a minute, are you an investor or are you a trader?" Well, I like investing. I like making the money work for me rather than me working for the money. Long story short, about a year ago, I said, "Listen, Javi, you need to figure this thing out. You need to learn how to make consistent money in the stock market." I put a lot of time, put a lot of effort, a lot of errors, because in the beginning, nobody was giving me advices. Nobody was telling me what to do. Nobody was pointing at the right direction. And that's exactly why I'm doing this right now, because I was able to figure it out where it started to click to me, and I have done all right this year. I cannot complain. Therefore, a lot of people ask me, "Hey, Javi, can you teach me how to do it? What you've been doing, how you've been able to profit consistently? Please share it out." And that's why, I started this channel. Today is the first one officially. I'm talking to a couple guys, very smart people that are willing to put the effort and do whatever it takes to make sure that they learn, get this down, and be able to turn this into consistent profit and additional income on top of what you're doing, or you can focus on it and make it so it makes enough money for you to live. All right, so let's get right into it. So you have an idea, and you kind of know what I've been doing this year so far. I am 474.24% up versus the Dow Jones that is only 2.78. The S&P 500 is 11.84. So I am killing it. Okay? And I'm going to teach you how I do it. Okay? So stay tuned. All right. So there's a couple things you need to understand. Okay? I do not buy and hold. I used to do that, and it happened to be a mistake. Okay? The reason why I have two brokers is because I started with E-Trade. I lost $35,000 in 2013, and I decided to stay away from trading for a while until I figured it out. So in 2019 in April is when I said, okay, well, I got to figure this thing out. And that's when I decided to put 8 hours worth of study every day until it finally clicked in. Okay, so I started trading with Robinhood, and then once I figured it out, then I started trading with E-Trade. Okay. Why do I trade with E-Trade? I believe E-Trade has a better execution time, and it has a lot of cool features. I feel that Robinhood sucks, even though it's good to get started. Once you start, going to the next level, I would recommend you find a different broker. Some people like Thinkorswim. I actually do for the scanners, but I don't. I'm not a fan for the option trading. But anyways, Thinkorswim, E-Trade, there's a whole bunch of others, but those are the ones that I've used the most. Okay, so what is option? Okay, so the first thing you need to understand is the basic. If you do not understand what an option is, you're not going to be able to get far with the strategy that I use. So let's pick an example of Apple, right? I love Apple because it's a great company. So that's why you're always going to be heavy dealing with Apple and trading with Apple and using Apple as an example. But anyways, so an option is a contract. And there's two types of contracts. One is the put, and the other one is the call. You see it right here, put and a call. and you can buy the put or you can sell the put, and you can buy the call or you can sell the call. So, like we said before, an option is a contract. There's two types of contract: call and option, and put right here. Call and put. I wish I can use the mouse. I don't know if you guys can see it or not, but anyway. So the call contract allows you to buy 100 shares, because this contract controls 100 shares, at the strike price, which is this one, and you have to do it at the expiration day. Okay? So you can buy the contract or you can sell the contract. When you buy the call, you have the right to buy 100 shares at the expiration day. When you sell the call, you have the obligation to sell 100 shares at the strike price at the expiration day. When you buy, you have a privilege. When you sell, you have an obligation. So get that down. Buying automatically related to privilege. Selling automatically related to an obligation. A call allows you to buy at the strike price at the expiration day. The put, on the other hand, allows you to sell 100 shares at the strike price at the expiration day. And this is very important that you understand it. So, first things to remember: when you buy, you have a privilege. When you sell, you have an obligation. Second thing to remember: call is a contract that allows you to buy at the strike price at the expiration day, regardless of the underlying price of the stock. A put, on the other hand, is a contract that allows you to sell at the strike price at the expiration day, regardless of the price of the underlying stock at the expiration day. Some people say, okay, but why would you do that? Why would you even buy or sell a contract? Let's put it this way. Let's say you like this pen, this highlighter, right, or pen. And you look at this pen, you know this pen, you know the quality of this pen, you know this pen is amazing because it's also a highlighter and it's also a pen, and it's really good, it lasts forever, the ink doesn't dry out fast. You know it's a good pen. This pen right now is trading at $1. And you say, listen, I want to buy 100 of this pen, but I don't want to buy it now because I think I want to buy it later, but not now. So I want to have the obligation to buy 100 of these pens for $1, but I want to buy them 100 days, a month from now, I mean. So you want to make sure that you're going to buy it at $1. So what you do is you buy a call. When you buy a call, you have the privilege, right? You have the privilege of buying 100 of these pens at $1 at the expiration of a month from now. If the price of the pen goes to $2, you just made 100% double on your on the price of the strike, because you have the privilege to buy at $1, and it's trading at the expiration day at $2. So you can buy it at $1 and sell it at $2 immediately. You buy with $100, you sell for $200, and whatever you pay for the premium, let's say you pay $50 for the premium, that you have to deduct. So let's say you sell it for $2, you bought it for $1, but you pay $50 for the contract. That's a total cost of $1.50 per share, therefore $150. But there's the other type of traders like me that would do this. I do not want to buy the pen right now. I think the pen is very valuable, and I am willing to buy this pen for $1 if the opportunity arises. What I'm going to do is I am going to sell a put a month from now that expires a month from now. Strike price is $1, and I get paid $50, let's just say, to be able to sell that put, that contract that obligates me to buy 100 pens at $1 a month from now. So now immediately I get $50 credit to my account. That will mature over time, right? As the month is coming along. But I get 50. And if this pen trades any money over the $1, let's say even stays at $1, doesn't even go higher, no go lower, I get to keep the $50. If it goes to $1.50, I get to keep the $50. Whatever happens after $1, I get to keep the $50 regardless. I have no obligation. If the expiration date comes alive, boom, the contract expired worthless, I get to keep the $50. If this pen happens to go below $1, I have the obligation to buy 100 of them at $1. So let's say the pen goes to 75 cents. If it goes to 75 cents, I have the obligation to buy at $1. But hey, I got $50 for this contract. So my acquisition cost is 50 cents for this pen. Even though it went down to 75, I'm still making $25 on this trade. And once I get assigned, let's say I get assigned, I have to buy 100, it's a trading at 75. I got to keep the $50. I have to add another $25 to be able to buy. I have to add another $25 to be able to buy. So I bought at 75. My acquisition cost is 75 minus 25. It's $25, right? So I bought these stocks for $25. Are you with me so far? Do you follow me? If you have questions, please comment below. Just remember, you paid 100, but you got 50 for it. And the stock is trading at 75. So that's where the 25 comes from. But anyways, let's just say you get assigned, you buy the stocks that's trading at 75. You're not going to sell it at 75. So what you do is you sell a contract for $1.50 because you think this pen is worth more, or even $2. Let's just say this is a great pen. I'm trading it for $2. So you sell a contract for $2 and you get paid $25 for that contract. To have the obligation, so you sell a call, in this case, you sell a call, you have the obligation to sell 100 shares at $2 within a month, or at the expiration date of a month away. And now you get paid 25, you got paid 50 in the beginning, you got assigned, you bought at 100, and then later on you get assigned, you sell at 2, you made $50 plus 25 plus 100 because you bought at $1, you sold at 2.